Hello everyone, and thank you for joining us for episode 56 of Odds Are, your S&P 500 weekly market forecast. All right, let's take a look at what happened last week. So, we started off with a down day, then up, then down, then up, and then just kind of blew the cap off of it and went even higher on Friday. So what does that mean for our forecasts? Well, one, we did stay within the expected settlement range. We stayed within 43.43 to 45.44. Now, we did not have a breach of the breach points, and we'll talk more about that here in a little bit. And those of you who've been watching the show know what's coming up now after a week with no breach of the breach points. And we did not actually move in the direction that I expected. I thought we were going to encounter a little bit more resistance on the upper edge of that blue shaded area, the upper edge of the Bollinger Band range. Instead, the market just kind of continued to go up and stretch that upper edge upward. Again, I thought we were going to be going down. I did not think we were going to close up by that, 46.77 or above 45.75. I said that would take about 2 to 3 weeks to happen if that's the direction we were going in. And sure enough, it didn't happen. But still, I'm putting it as a red X because I thought we were going to have more resistance and go downward, and we did not. All right, so what does that do for the moving averages and setting us up for the coming week? All right, well, let's see. You have now bullish on the short term, medium term is neutral, and long term is bearish. This is a scramble from last week. Last week, short term was still bullish, but medium term was bearish and long term was neutral. So what does this actually mean? What's the story behind these moving averages? Well, the short term is still bullish because we are still on this reprieve, on this buy the dip, and that's just basically because the world didn't end, right? So we had been on this really pessimistic sentiment. Everything was going to heck in a handbasket, and all of a sudden we're like, hey, business is still moving along. Things haven't really kind of blown up. So we're bouncing back up almost as if it's business as usual, which we all know it's not. But that's where we look at the medium-term average. And the medium-term average is undecided, really. It's neutral. It has no idea whether we're going to be going up or down. And now the long-term moving average has finally shifted over to bearish territory. And that is telling us, hey, let's look back to where we were in January at 48.08. Technically, even though we're having these, up weeks, it's still not enough to offset some of the damage that was done. That's technically still bearish. I did call a couple weeks ago that once we flipped that long term to neutral, all bets were off and things were going to get a little bit crazy. It was not going to be, green across the board or blue across the board or even red across the board on these moving averages. And that's what we've been seeing play out here in these weeks. All right. Let's now take a look at what are the critical price points for next week. So we are finally back to somewhat of a normal setup here where the breach points are inside of the expected settlement range. So let's start with the breach points. 44.54 on the downside and 45.78 on the upside, with a 93.4% chance of a breach. You'll notice this is a little bit lower. As always, I try to tell you guys, I'm always, recalibrating, finding ways to make our systems more accurate. So this is a little bit lower, more conservative percentage, but still 93.4% is pretty high. So we are looking at a breach of one of those 2 points. Not non-directional bias, right? It's not saying one or the other, but it's a 93.4% chance that we're going to breach one of those 2 points in the week ahead. At the end of it, though, we are expecting it to close within 44.11 to 46.15 with a 72.05% chance of that occurring. Now take a look at that parabolic SAR. It's now at 46.49. So we're getting closer and closer to where at this point I'm going to say it's definitely in the realm of possibility. Still not very probable, right? I mean, we'd have to breach 45.78, blow past 46.15, and then end up above 46.49. But that's not impossible at this point. So keeping an eye on that. Eventually when that parabolic SAR ends up being within the expected settlement range, that's when things get interesting. But for now, we're just going to focus on the breach points because this is a very high probability of this week having a breach since last week we did not. All right, and let's wrap this into the relative view. So I'm keeping the keeping the yellow shaded area, which was the target that I said last week that if we broke into, that would be a very bullish indicator and that it could take a couple weeks to play out. Well, we got close. We got up there, but no cigar last week. So if we have that opportunity this week, then this could easily close up in that range there where you see it's just above the 45.78. 46.15 is fair game, and even 46.49, which looking at that area, you can see I don't think we're going to close above 46.49, but anywhere in that yellow shaded area is fair game. No reason why we can't close in that range. Now look below that though, and look at that 44.54 and then 44.11, which of course would mean we're going back down towards that red midline, magnet effect time. If we go back past 44.54, I think there's a greater chance of us closing below the 44.11 lower settlement range, just because I think we will actually end up coming back towards that midline wherever it may be, which by the middle of the week, that's probably going to be somewhere around 44.40, 44.50, somewhere in that range. But that's the other side of that play. Now, looking at these, curves here, right? These bounce ups. I kind of adjusted the second one and expanded it out to see what's kind of playing out in the weeks preceding this. It looks like we are going back up and testing that yellow shaded area, right? So the yellow shaded area originally was where we first said the dead cat bounce kind of like started originally, and then the second one bounced back down, now curved back up. This, honestly, we could see some resistance going down, and that's where that 44.54 would get breached. I'm going to give it about a 70% chance. This is my call right now. 70% chance that we're going to be going down to the 44.54 breach point. That being said, I will not discount the possibility of a double breach. That happens too. We can breach 45.78 and come down and breach 44.54. But my guess is we're going to go back down and hit that 44.54. We're going to have a little bit of a cool down period here. I don't think we're going to continue another week up to the moon. So that's my thoughts. All right, and now getting into, didn't see that one coming. Well, obviously I didn't see what happened last week coming because I thought it was going to go down last week. I thought we were going to have a little bit of a cool down period and some resistance pushing the market down last week, and that did not happen. Looking at next week, another great opportunity for you guys out there. If you guys are options traders, if you see the opportunity to get in on some of these, I'm giving you a high probability trade. Some people are more comfortable doing that than others, but if you have the opportunity, hey, this is a good chance to capture some of that market movement that we're forecasting ahead. So hopefully you guys are able to do that. Also, if you guys have any questions about that, please feel free to hit me up in the comments and ask any questions about how you can put on a position or a structure that could take advantage of these forecasts. All right, and now let's wrap up with the quote of the week, and this one is by Mr. Ed Seykota, and honestly, the guy's just a trading legend. From everything that I've read, he's known by many to be one of the first real systematic traders, where he actually had a trading system, like algorithmic trading, and he has been written about in Market Wizards, Jack Schwager, and so he's definitely made a name for himself. And I love this quote because Ed says, "The feelings we accept and enjoy rarely interfere with trading." Now that sounds nice, but if you just stop there, you're missing the point, because you have to turn it on its head and then ask yourself, so you're saying that the feelings that we don't accept and we don't enjoy do interfere with our trading? And that is where I think the golden nugget is in this quote, because the things that we don't accept, if you don't accept or you're not willing to accept failure, if you're not willing to accept the fact that you have to learn and go through a training period, or you need to cut your teeth on this market, you need to really get in there, and you're going to have ups and downs, and there's going to be things that are unexpected, and you're going to be wrong on some days. A lot of days you will be wrong, but you know what? If you can't accept that and you can't enjoy that ride, if that is just makes you sick to your stomach and you don't enjoy that feeling, that's going to interfere with your trading. That is going to handicap you. So knowing that you have to accept the thrill of the ride, you have to accept the ups and downs, you have to accept the learning process, and you have to enjoy it, that's when you can make those things no longer be interferences. They're not going to be obstacles to your trading. Instead, they can become stepping stones. So, love this one by Ed Sikota. And on that note, we will wrap up. Guys, enjoy the rest of your week. Take care, and I will see you guys back here next Sunday.